In a market dazzled by Tesla's trillion-dollar valuation and Toyota's rock-solid reputation, one company hides a multi-brand empire beneath a dusty hood. It builds Porsches, Audis, Lamborghinis, yet its shares trade like a forgotten relic. Welcome to the riddle of Volkswagen Group. Roughly $355 billion in 2024 revenue and 9 million vehicles sold, yet valued by Wall Street at just $55 billion. Let's unpack why that gap exists and whether it's a value trap or an overlooked opportunity. 2024 sales revenue, €324.7 billion, about $355 billion, the largest of any automaker. Vehicles delivered, 9 million, roughly equal to Toyota and 5 times Tesla. Brands, Volkswagen, Audi, Porsche, Lamborghini, Bentley, Bugatti, Ducati, Skoda, Seat, and variety of trucks. Yet investors award the whole group a market value of $55 billion. Tesla stands at $1.09 trillion, while only delivering less than 25% of what VW delivers. Toyota stands at $286 billion, while roughly delivering the same amount of cars as VW, and even Ferrari stands at $119 billion, while selling under 15,000 cars a year. Volkswagen isn't one tidy company. It's a constellation of brands that analysts often describe as a 4-layer structure. 1. Brand Group Core. The high-volume marques, Volkswagen passenger cars, Skoda, Seat, and Volkswagen commercial vehicles. Together they move nearly 5 million vehicles a year and generate about 2/5 of group revenue. 2. Brand Group Progressive. Audi plus its premium spin-offs Lamborghini, Bentley, and Ducati. Think cutting-edge tech wrapped in luxury leather. 3. Brand Group Sport Luxury, now essentially Porsche alone. Even after the 2022 IPO, Volkswagen still owns 75% of Porsche AG, so most of those 9/11 profits flow right back to Wolfsburg. 4. Trucks. Heavy-duty specialists, Scania, MAN, Volkswagen Truck and Bus, and Navistar, all steered through the listed holding company Traton SE. Results roll up through these 4 brand groups, and then through Volkswagen's 2 share classes, so outsiders have to peel multiple layers just to see who really owns the cash flows. Volkswagen has 2 faces on the stock market. One pays the dividend, the other runs the company. 1. Ordinary shares, tickers VOW in Frankfurt and VWAGY in New York, have all the voting power. 2. Preferred shares, tickers VOW3 and VWAPY, come with a slightly higher cash dividend, but 0 votes. Cash and control are literally sold in 2 different wrappers. Roughly 59% of Volkswagen's equity sits in the ordinary line, but that 59% commands 100% of the ballots. The other 41%, where most day trading happens, gets no voice at the annual meeting. The German state of Lower Saxony adds a 20% blocking veto by law. Qatar Investment Authority holds 17% of votes, and the global free float gets the final sliver, about 10%. Inside the ordinary bucket, the Porsche PA family vehicle, Porsche SE, ticker POAHY, owns just 31.9% of Volkswagen's money, yet wields 53% of the votes. So outsiders can buy every preferred share ever printed, but Porsche SE still steers the ship. That's why price discovery is distorted, why index funds hesitate, and why Volkswagen's valuation riddle keeps puzzling Wall Street. Why the discount persists. 1. Dieselgate overhang. More than €33 billion in fines and settlements since 2015 keep ESG money cautious. In September 2015, U.S. regulators discovered that many Volkswagen-built diesel cars contained hidden defeat device software. When the vehicles sensed they were being lab tested, the code dramatically reduced nitrogen oxide emissions to meet legal limits. Out on the road, the engines reverted to normal settings and polluted up to 40 times the legal cap. The scandal quickly spread worldwide. 11 million vehicles across Volkswagen, Audi, Porsche, Seat, and Skoda were ultimately implicated. Volkswagen has since paid €33 billion, about $36 billion, in fines, buybacks, fixes, and civil settlements, the largest corporate emissions penalty in history. Several executives faced criminal charges. The CEO at the time, Martin Winterkorn, resigned within a week of the disclosure. Beyond the financial hit, Dieselgate damaged Volkswagen's global reputation and still colors investor perception nearly a decade later. 2. Software delays. Cariad's first-generation EV stack slipped over 18 months, letting Tesla set the standard. 3. Governance knot. Dual shares, family votes, and state blocking rights complicate any quick re-rating. Why the story could change. Volkswagen has approved €180 billion, about $193 billion, of investment for 2023 to 2027, two-thirds earmarked for EV platforms, battery gigafactories, and software. A rebuilt Cariad stack will power the SSP platform due in 2026 across VW, Audi, and Porsche. Even cautious some of the parts math adds up quickly. First, Porsche AG. The sports car IPO trades around €44 billion today. Volkswagen still owns 75%, so their slice alone is roughly $33 billion. Second, Audi. BMW is valued at about 6 times annual operating profit. Apply that same 6 times multiple to Audi's 2024 EBIT, and you get about €40 billion. Third, the exotics. Recent Ferrari and Aston Martin deals imply 4 to 5 times sales for ultra-luxury. Lamborghini and Ducati together do about $3.5 billion in revenue, so a mid-range multiple prices them near $15 billion. Finally, the heavy stuff. Traton Scania, MAN, and Navistar already has its own Frankfurt ticker, worth around €15 billion. Volkswagen's 89% stake equals $13 billion, and management says the new PowerCo battery unit will carry at least $2 billion in equity value. Round that plus cash to $10 billion. That exceeds $100 billion versus today's $55 billion quote. Volkswagen might be the most misunderstood blue chip on the planet. A $300+ billion revenue engine priced like a mid-cap because of complexity, control layers, and old scandals. Is that mispricing permanent, or the bargain of the decade? Subscribe if you value deep dive research, and drop a comment on which company you'd like me to analyze next.